8 crashed. Silver drops 10%. The liquidity crisis is happening. The financial markets have just experienced something catastrophic. Silver has collapsed by 10% in a single session. Gold simultaneously crushed. This is not a correction. This is not profit-taking. When the world's oldest stores of value fall together, when institutions dump their most liquid assets in desperation, you are watching the early stages of a liquidity crisis, the kind that preceded 2008, the kind that froze markets in 2020. But this time, the scale is different. The question is not whether silver will recover. The question is, what breaks next? Welcome to Financial Announcement, where we analyze the market movements that matter before they become headlines. If you've built a career understanding how money moves, if you've watched enough market cycles to know that chaos always leaves clues, then consider subscribing to this channel. We don't chase views. We document the mechanical reality of financial systems under stress. And we'd appreciate knowing from which part of the world are you watching this unfold? Let us know in the comments below. Now, let's dissect this crash with precision. The trading screens across global financial centers displayed something that seasoned traders had not witnessed in years. Silver, the metal that industrial economies depend upon for everything from solar panels to smartphones, had fallen by more than 10% in a matter of hours. The price stood at a level that reflected not calculation but panic. Gold, traditionally the most stable asset in times of uncertainty, had dropped over 3% in the same session. When both precious metals fall simultaneously with such violence, experienced market observers understand they are not watching a normal market correction. They are watching a liquidity crisis unfold in real time. A liquidity crisis operates on a principle that contradicts basic market logic. In a normal market decline, investors sell assets they believe are overvalued. They make calculated decisions based on fundamental analysis. But in a liquidity crisis, institutions do not sell what they want to sell. They sell what they can sell. This distinction is critical to understanding the current market chaos. Consider the position of a large institutional fund managing billions of dollars in assets. This fund holds stocks, bonds, real estate investments, private equity stakes, and precious metals. When market conditions deteriorate rapidly, their broker issues a margin call. The fund must deliver billions of dollars in cash within hours or face forced liquidation of their entire portfolio. The fund managers look at their holdings and face a harsh reality. Their bond positions cannot be sold quickly because the bond market itself is experiencing stress. Buyers have disappeared. Their real estate investments take months to liquidate. Their private equity stakes are completely illiquid. But their gold and silver positions trade in global markets that operate 24 hours a day. These metals have buyers in London, New York, Shanghai, and Mumbai at any given moment. The fund has no choice. They execute massive sell orders on their precious metals holdings. They are not selling because they believe silver is overvalued. They are not selling because they think gold's fundamentals have deteriorated. They are selling because these are the only assets liquid enough to generate the cash they desperately need to survive the next 48 hours. This forced selling creates a cascade effect. When billions of dollars of sell orders hit the precious metals market simultaneously, prices collapse. Other funds and trading algorithms detect this price movement. Some of these other institutions are also operating on thin margins. When they see their gold and silver positions losing value rapidly, their own brokers issue margin calls. Now these institutions must also sell their precious metals to raise cash. The crisis feeds on itself. Silver falls harder than gold because of a mathematical reality. The global silver market is significantly smaller than the gold market. When the same amount of forced selling pressure hits both markets, the smaller market experiences greater price volatility. This is why silver dropped 10% while gold dropped 3%. The fundamental ratio between the two metals has not changed. The industrial demand for silver has not disappeared. What has disappeared is financial liquidity. Industrial manufacturers still need silver for battery production. Solar panel factories have not stopped requiring silver paste for their photovoltaic cells. Electronics companies continue to use silver in circuit boards and connectors. The real economy's demand for silver remains intact, but in a liquidity crisis, financial demand overwhelms fundamental demand. The retail investor watching their portfolio value decline sees only red numbers on their screen. They do not see the mechanics operating behind those numbers. They do not understand that institutional fund managers and glass towers across major financial centers are making forced decisions that have nothing to do with silver's intrinsic value. This is why understanding the anatomy of a crash matters more than reacting to it emotionally. The price on the screen reflects temporary liquidity conditions, not permanent value destruction. But recognizing this distinction requires looking beyond the immediate panic and examining the mechanical forces driving market behavior. The question facing every investor now is not whether silver is fundamentally worth less today than yesterday. The question is how deep this liquidity crisis runs and what other markets will be affected as it spreads through the global financial system. Behind every dramatic market collapse lies a network of interconnected financial relationships that most investors never see. These relationships form the hidden architecture of modern finance, and when stress enters the system, this architecture transforms from a source of efficiency into a mechanism of destruction. The story of today's precious metals crash begins not in the commodity markets, but in the derivatives markets where institutions place leveraged bets on interest rates, currencies, and bond yields. A single hedge fund operating with 30 to 1 leverage can control $3 billion in assets with only $100 million of actual capital. This leverage amplifies profits during calm markets, but it becomes lethal when markets turn violent. Imagine a fund that made a calculated bet on Japanese government bonds 3 months ago. The trade appeared sound, interest rates were stable, currency hedges were in place, risk models showed acceptable parameters. But last week, the Bank of Japan made an unexpected policy announcement. Bond yields moved by amounts that the risk models classified as statistically impossible. The fund's position, which was profitable days earlier, suddenly showed losses exceeding their entire capital base. The prime broker managing this fund's accounts immediately issued a margin call. The fund needed to deposit additional cash to prove they could cover their losses. The deadline was not weeks or days. The deadline was hours. In the old era of finance, institutions had time to arrange orderly asset sales. In the modern era of algorithmic risk management, time has been compressed to almost nothing. The fund's portfolio manager faced an impossible decision tree. Selling their Japanese bond position would lock in catastrophic losses and trigger investor redemptions. Selling their stock portfolio during market hours would move prices against them, as other algorithms detected their forced selling. Their real estate and private equity holdings might be valuable, but they could not be converted to cash before the margin call deadline. Only one category of assets in their portfolio met the critical requirements. The assets needed to be globally traded, highly liquid, and held by the fund in sufficient size to meet the multi-billion-dollar cash requirement. Gold and silver satisfied all three conditions. The portfolio manager instructed their trading desk to sell their entire precious metals position immediately, regardless of price. The sell order entered the market through multiple exchanges simultaneously. In London, market makers saw unusually large sell orders appearing in their systems. In New York, commodity trading desks detected the same pattern. The algorithms that provide liquidity to these markets are programmed to step back when they detect institutional distress selling. They are designed to protect their operators from being the counterparty to a collapsing institution. As liquidity providers withdrew, the bid-ask spread in silver futures widened dramatically. A spread that normally measured pennies suddenly measured dollars. Each successive sell order executed at a lower price than the previous one. The fund that needed to raise $5 billion found that by the time their orders finished executing, the market had moved so far that they needed to sell even more metal to reach their cash target. Other institutions monitoring these markets recognized the signature of forced liquidation. Some of these observers were themselves operating with high leverage. They watched their own precious metals positions decline rapidly in value. Their risk management systems automatically calculated that if prices fell another few percentage points, they too would face margin calls. A brutal logic took hold across the institutional landscape. Funds that were not in immediate distress began selling their gold and silver positions preemptively. They reasoned that if they waited, prices would fall further, and their eventual forced selling would occur at even worse prices. This preemptive selling accelerated the cascade. The market was no longer falling because of one distressed institution. It was falling because dozens of institutions were simultaneously trying to exit through the same narrow door. The traders executing these orders felt no emotion about precious metals. They were not making judgments about silver's industrial utility or gold's monetary properties. They were following instructions generated by risk management systems that treated all assets as interchangeable units of liquidity. In that moment, silver was not a metal. It was simply the most efficient method of generating cash before the margin call deadline expired. This is how a crisis in Japanese bond markets creates a crash in silver prices 8,000 miles away. In the chaos of collapsing asset prices, a curious phenomenon emerges that confuses even experienced investors. While silver and gold plummet, the US dollar surges upward with unusual force. This appears contradictory at first glance. After all, precious metals are traditionally supposed to rise when confidence in paper currencies declines. Yet during acute liquidity crises, this relationship inverts completely. And understanding why reveals something profound about the architecture of global finance. The dollar occupies a unique position in the world's monetary system. It is not merely the currency of the United States. It functions as the foundational settlement layer for international trade and finance. When a manufacturer in Germany purchases raw materials from a supplier in Brazil, that transaction typically settles in dollars. When a pension fund in Japan buys corporate bonds issued by a French company, those bonds are often denominated in dollars. This creates a permanent structural demand for dollars that exists independent of American economic conditions. During normal market conditions, this structural demand remains relatively stable. Banks and corporations maintain dollar reserves adequate for their operational needs. Credit flows freely. Institutions can borrow dollars when needed and repay them without difficulty. But when a liquidity crisis begins, the entire system's behavior changes fundamentally. Banks that were lending freely days earlier suddenly become reluctant to extend new credit. They recall existing loans where possible. They demand additional collateral from borrowers whose positions have weakened. This credit contraction occurs simultaneously across thousands of institutions worldwide. Each individual bank is acting rationally to protect itself, but their collective behavior creates a system-wide shortage of dollar liquidity. Corporations and investment funds that relied on ready access to borrowed dollars suddenly find those credit lines unavailable. They have dollar-denominated debts coming due. They have operational expenses that must be paid in dollars. They have margin calls requiring immediate dollar delivery. But the dollars they assumed would be available through normal credit channels have vanished. This creates what economists call a dash for cash. Institutions begin liquidating any asset they own that can be quickly converted to dollars. They sell European stocks to get euros, then sell those euros to get dollars. They sell Japanese bonds to get yen, then sell those yen to get dollars. They sell gold and silver, receiving dollars directly. Every one of these transactions increases demand for dollars relative to other assets. The dollar index, which measures the dollar's value against a basket of foreign currencies, begins rising sharply. Traders monitoring currency markets see the index climbing through technical resistance levels. This rising dollar creates a mechanical headwind for all commodities priced in dollars. When the dollar strengthens by 5%, a commodity must become genuinely 5% more valuable just to maintain the same dollar price. For silver, this creates a devastating double impact. The metal faces selling pressure from institutions liquidating for cash. Simultaneously, the strengthening dollar makes silver mechanically more expensive for international buyers. A buyer using euros or yuan finds that silver's dollar price may have dropped 10%, but their currency has weakened against the dollar by 4%. The effective discount they see is smaller than the headline number suggests. This reduces their buying interest precisely when the market needs buyers most. The paradox becomes almost philosophical at this point. Investors who own precious metals often do so specifically because they distrust fiat currencies and monetary policy. They have studied monetary history. They understand that currencies unbacked by tangible assets eventually lose purchasing power. Yet during a crisis, these same investors watch the fiat currency they distrust becoming the most desired asset in global markets. This happens because markets operate on two different time horizons simultaneously. In the long term, the fundamentals of monetary debasement remain unchanged. Central banks continue to expand money supplies. Government debts continue growing. The structural arguments for holding precious metals stay intact. But in the short term, survival trumps philosophy. An institution facing a margin call in 6 hours cannot wait for long-term monetary trends to play out. They need dollars now, regardless of what those dollars might be worth in 5 years. The deflationary pressure wave moves through markets with a peculiar selectivity. Cash becomes king, but only one specific type of cash. Dollar-denominated treasury bills and bank deposits surge in value. Everything else falls. Stocks fall, bonds fall, commodities fall, real estate values decline. Even assets with strong fundamental value cannot escape the gravitational pull of the liquidity vacuum. Financial markets possess a peculiar form of memory. They forget the lessons of previous crises with remarkable speed during prosperous times. Yet when a new crisis emerges, the behavioral patterns from past disasters resurface with eerie precision. The current silver crash is not a novel phenomenon. It is a recurring script that has played out during every major liquidity event of the past 2 decades, and examining these historical precedents reveals something crucial about what comes next. October 2008 marked one of the most violent periods in modern financial history. Lehman Brothers had collapsed the previous month. Credit markets had frozen completely. Banks refused to lend to each other because no institution trusted that the borrower would survive long enough to repay. In this environment, gold initially behaved exactly as conventional wisdom predicted. It rallied as investors sought safety. But then something unexpected occurred. Between October 10th and October 24th, 2008, gold crashed by nearly 30%. Silver fell even harder, declining by 45% in the same 2-week period. Investors who had purchased precious metals specifically as crisis protection watched in disbelief as their insurance policy lost half its value during the exact crisis it was supposed to protect against. The confusion was understandable. These investors had read the analysis. They understood the arguments. Gold was supposed to rise during financial chaos. Instead, it was collapsing alongside stocks, bonds, and real estate. The explanation became clear only in hindsight. Hedge funds and investment banks were experiencing what later became known as the Great Deleveraging. Firms that had operated with 30-to-1 or even 50-to-1 leverage ratios suddenly faced margin calls that dwarfed their available capital. These institutions owned gold and silver not as philosophical investments, but as portfolio components that provided returns and liquidity. When survival became the only priority, they liquidated everything that could be sold. The fact that gold and silver were supposed to be safe havens became irrelevant. They were liquid assets, and liquid assets got sold. But the story did not end with the crash. By December 2008, gold had recovered its October losses. By 2011, it had more than doubled from those crisis lows. Silver's recovery proved even more dramatic. The metal that touched $10 during the panic traded above $48 within 30 months. The institutions that sold at the bottom had made a catastrophic error. They had confused temporary illiquidity with permanent value destruction. March 2020 provided another case study with different characteristics but similar underlying mechanics. When COVID-19 lockdowns spread globally, financial markets experienced a crash that compressed months of volatility into days. Gold fell from $1,700 to $1,500 in 2 weeks. Silver crashed from $18 to $12. And once again, the safe haven assets were falling during maximum uncertainty. The Federal Reserve's response in 2020 was unprecedented in scale and speed. Within days, the central bank announced unlimited quantitative easing, corporate bond purchases, and lending facilities that provided dollars to any institution that needed them. The liquidity crisis ended almost as quickly as it had begun. Gold reached all-time highs within 5 months. Silver doubled from its March lows by August. These historical episodes reveal a consistent pattern. Liquidity-driven precious metals crashes are violent but brief. They create price dislocations that have no relationship to fundamental value. Industrial demand for silver does not collapse by 40% in 2 weeks. Solar panel manufacturers do not suddenly stop needing the metal. Electronics production does not halt. What collapses is financial demand, and financial demand is the most volatile component of precious metals pricing. The recovery pattern follows a predictable sequence. First, central banks intervene with emergency liquidity measures. They recognize that allowing a liquidity crisis to run unchecked risks systemic collapse. The Federal Reserve, European Central Bank, and Bank of Japan flood their banking systems with cash through various mechanisms. This intervention stops the forced liquidation cascade. Second, the institutions that sold precious metals at distressed prices attempt to rebuild their positions. They recognize that they sold assets worth significantly more than the prices they received. But they cannot simply buy back immediately. Their risk management systems and investor mandates require time to reset. This creates a period of price stabilization where selling pressure has ended, but buying pressure has not yet resumed. Third, new buyers emerge who did not own precious metals before the crisis. These buyers studied market behavior during the panic. They watched industrial demand remain strong while financial selling drove prices down. They recognize the dislocation between price and value. They begin accumulating positions at what they correctly perceive as crisis-generated discounts. The current silver crash is unfolding against a backdrop that differs from both 2008 and 2020 in important ways. Government debt levels are higher. Inflation concerns persist despite recent price declines in various sectors. Geopolitical tensions have intensified. Central bank balance sheets remain enormous even after recent reduction attempts. These factors suggest that when the current liquidity crisis resolves, the subsequent recovery may develop characteristics unlike previous cycles. What remains consistent is the core principle. Forced selling creates temporary price dislocations. Value does not disappear. It becomes temporarily unavailable for discovery because market participants are focused on survival rather than valuation.